So you're looking to buy a home and you're kind of confused as to where to go for your mortgage pre-approval. I don't blame you. There's so many options out there. Do you go online? Do you go to the bank? Do you use a mortgage broker? There's a lot of confusion out there in terms of what a pre-approval is and how to get a proper pre-approval. So by the end of this video, you will know exactly where to get your pre-approval, what a pre-approval is, and some insider information that nobody else out there is talking about. And this is stuff that a lot of banks and mortgage brokers don't want you to know. So be sure to stick around as there's some tips in here that will save you some money. So let's start off with what the difference is between a pre-qualification and a pre-approval. So this is what really trips a lot of people up, the words pre-qual and pre-approval. So pre-qual is in pre-qualification. And you can think of a pre-qualification, to put it quite simply, it's garbage. You don't want this for a pre-approval because there's no credit checks, there's no review of income or down payment documents. There's quite literally no review of anything. It's just either online spitting out a number based off of your income and down payment that you put in, or it's someone at the bank who was either lazy, haven't collected your documents, or they're untrained, or they just wanted to go the pre-qualification route for whatever reason. You want to avoid this at all costs. So make sure whenever you're getting a pre-approval, you have your income checked, your down payment checked, and your credit. Those are the three main criterias. So when it comes to the income, you want to make sure they're collecting the documents that apply to your specific situation. So if you're employed, that's typically going to be T4s, pay stub, and letter of employment. If you're self-employed, that's typically going to be a notice of assessment, T1. And if you're incorporated, there's a few extra documents there as well. In terms of down payment, pretty simple. They're going to look at your bank statements. If you have the money held in either a savings account, checking account, or investment account, those statements are going to show that you have that down payment there. And the reason why it's important to review these documents specifically upfront is because lenders, they will look for any large transaction within the last 30 to 90 days. So any large transaction, we have to source where that came from. And a lot of the times, just the general public, they don't understand that the down payment has to come from credible sources. You can't just have $20,000 stashed under your mattress and deposit it into your account today and use that as your down payment. Lenders won't accept that because it has to come from a verifiable source under the Anti Money Laundering Act. They have to go by these rules. So it's important that wherever you go for your pre approval, that person is checking your down payment history and sources through the statements. So, another example of where a pre qualification can go wrong, let's say you're a registered practical nurse and you're working as a temporary position. So, you pick up shifts here and there, there's no set amount of hours that you get. So, this is where things are going to play out very differently on what income we can use. So, instead of using the last year's $70,000, we can't use a base salary or a base hourly amount because you're temporary. So those hours aren't guaranteed. So we can't use that. So what we have to default to is a 2 year average. So with the 2 year average, what lenders look at are the previous 2 years on what you made from a gross annual income perspective. So this doesn't just apply to this nurse, but let's just continue with this example. Let's say that nurse made $70,000 last year, and the year prior, she made $40,000. We have to use a 2 year average of those two incomes. We can't use the last year's income alone. So in that example, we're going to have to use 55,000 as the 2 year average, which is $15,000 less than that 70,000. So if we used that $70,000 that was inputted on the online application, then that would have amounted to another $67,000 from a pre-approval perspective. So that's $67,000 from a mortgage amount increase. That is a big difference when it comes to offering on homes. So I don't know about you, but when I'm out there shopping for a home, I want to make sure my pre-approval is rock solid and that I get an approval from the bank, especially if I'm going in without conditions with my offer. That's a whole other conversation, but bottom line, get a proper pre-approval with someone that's looking at all the documents. Now, for the second tip, make sure your pre-approval is specific to the property that you want to put an offer in on. And the reason why I say that is because your pre-approval is going to fluctuate depending on the property itself. So if that property has condo fees, or it has a higher property tax amount than what was originally inputted on your pre-approval when you first got it, that's going to make a big difference as to what you can afford. So what we do with North Shore Mortgages is we do custom budgeting, and we make a custom and ongoing specific to properties as you go out there shopping for a home. So that way, you know, if you're putting an offer in on 123 Smith Street, then you're going to know down to the dollar how much you can afford and how high you can go for an offer amount. So one of my biggest pet peeves is we have clients coming from the bank. A lot of times they get their pre-approval 3 months ago, and either the rate has changed, which affects the affordability affordability as well. Or in this example, if they've looked at several homes and the bank hasn't been adjusting their pre-approval amount, that can go south very fast, especially if they're putting an offer in on a property that has condo fees, which wasn't originally accounted for. This can be disastrous for that client. They can be caught with a decline and not get approved with financing going forward. Now, this next tip that I'm about to go through is very important. It's going to save you thousands of dollars, and it's a question you should be asking when you get your pre approval. But before we do that, please hit that subscribe button if you're finding any value here. Again, our goal with this channel is to just save Canadians a lot of money and just uncomplicate mortgages and real estate. So, point number three, ask about rate holds. So, rate holds are often valid for up to 120 days. So, when you get your pre approval, your broker or the bank should be holding a rate for you. So, in a rate increasing environment, you want to make sure your rate is held because for one, that's going to save you money. The lower the rate, the more money you're going to save. And secondly, this is going to help you qualify because of the stress test. So, to simplify how the stress test works, if you have a higher rate, then there's a good chance that you're going to qualify for less. Depending on how high that rate is, we're not going to go into the specifics in this video, but just keep in mind if you are going forward and you don't have a rate held and rates are increasing, there's a potential you qualify for less when that rate increases. And of course, like I just mentioned, you're going to miss out on some savings. So, one really important question you want to ask them is if they've held that rate for you, and not just one rate. Ask them if they've held a fixed rate or a variable rate, one lender, two lenders, multiple lenders. You want to ask these questions because unfortunately, not all brokers are treated equally. Some are lazier and they just don't take the time to submit these rate holds because it does take time. But at the end of the day, it's important for you and your family, your financing. So make sure you ask that question. So this next one is a bit controversial, and I'm probably going to get a lot of hate in the mortgage industry, but it's important you need to know this. Tip number four, make sure you ask your mortgage broker how many files they've funded in the last year. So there's a varying degree of experience in the mortgage industry, and you want to make sure you're with someone that has that experience. So as a mortgage agent or broker, it is a pretty low barrier of entry to get into, but there's a lot to learn. There's a lot of policies, underwriting guidelines. Every lender is different. So it's important that broker or agent has experience submitting files. So you want to ask them, how many files have you funded over the last year? This will give you a good indication as to how much experience they have. And at the very least, if they're a friend or family member and they have a mentor to lean on, then that definitely helps. If they have someone that they can have hold their hand through the process and that person has experience, then that's also a good alternative. But I would say that the best option here is just someone that has multiple funded files per month. And to give you an example of how an inexperienced broker can mess up here, it can start from the original phone call. So when we have phone calls with clients, we ask all the questions up front to see what their situation is before we collect the application and documents. So one thing we always ask in the upfront call is, have you been separated or divorced in the past? So I'm just using this as an example, and it sounds like an intrusive question, and it is more personal, but we need to know it. And the reason being is because any spousal or child support payments that you are inclined to pay, we have to include that in your application. Because if that agent or broker hasn't accounted for that child support or spousal payment, then chances are that pre approval amount is higher than it should be. And that can cause some issues for the client because if they're putting in offers at the higher pre approval amount, then things can go wrong and you get declined by the bank. So that's just an example. There's many, many different ways an agent or broker can mess up. Bottom line, experience is a must. So make sure you ask them that question. All right. This next tip is another spicy take. And again, I'm probably going to get some hate for this, but it's important you know. So tip number five, compensation for mortgage brokers and banks vary. So, for the most part, mortgage brokers are pretty upfront and honest, but like any industry, any career, there's always going to be some bad apples, and some brokers may not be upfront as much as they should be. And what I mean by this is we're compensated differently based off of the term length and the lender we place your file with. So, some lenders pay different. Some term lengths pay different. So, to give you an example, a 5 year term typically pays us the highest. So, if your agent or broker isn't going through all of the options from a short term fix to a 5 year fix to a 5 year variable, those options all need to be laid out on the table. And if you're feeling like you aren't presented all of the options, there could be a chance that broker is hiding the short term fix because they just want to get that 5 year fix or that 5 year variable compensation. I do like to think there's a lot of great mortgage brokers and agents in the industry, and a lot of them are upfront, honest, but there are going to be some bad apples out there. So you just want to make sure all of your options are presented upfront. And if you kind of have that inkling or that feeling that there's something being held back, then I think it's time for you to change and look at different options. So to give you an example, let's say you have a goal of paying off your mortgage faster. Now, let's say all things considered, lender A and lender B are treated equally, but there's one factor with lender B that is different from lender A, and that's their prepayment privilege. Prepayment privileges allow you to pay down the mortgage quicker. When you sign on to that term in that lender originally, you're going to have a certain percentage that you're able to allocate towards that mortgage on an annual basis. So some lenders may offer you a 10%, some may offer you 15, 20% prepayment privileges. They're all different. And ideally, you want to have the highest prepayment privilege. So let's say lender B offers a 20% prepayment privilege and lender A offers a 10%, then it's probably in your best interest to go with lender B because, again, your goal is to pay down the mortgage quicker. But lender A has a higher compensation. So you do want to make sure that it's not just rate, there's other facets and features within the mortgage that are important. So you need to communicate with your mortgage broker too. It goes both ways. You can't just go up front and say, hey, I want the absolute lowest rate, because if that's the case, they might just shop around and find the lowest rate. And maybe you're limited with the prepayment privilege as a feature in that example. And speaking of paying off your mortgage quicker, check out this video right here where we go over the best 5 tips on how to become mortgage free.